So a lot of investors feel like there's no more good deals out there, whether all the deals are gone or interest rates make it so difficult to cash flow that they can't proceed with the purchase. Well, it's actually the opposite for us. We have a inventory list of properties at work, and a lot of our investors are stuck trying to figure out of all these options, which one's the best for me. Why I often sometimes shortcut the conversations by thinking what I would do if I were in their shoes. And we don't have to guess. I can just share with you today what I did do. So every single year I have to buy a property. A big part of that is for the tax benefits. I get to offset a lot of my business earnings for the year and offset my taxable income. And so I'm always looking at what the best property is for my portfolio's need. And what we're looking at here today is the same model of the property that I purchased for myself. The previous video, and I can put a link up, will walk you through my family and I's journey to that property and how I kind of encourage them to take part in what we're doing as a family as far as growing our wealth. So this is not the same exact model. Some other things are different. The one that I purchased has a little bit more of a elevated feel that's now common amongst all of the duplexes, but the functionality is exactly the same. It's a 2-bedroom, 2-bath. And the reason why we like functionality is right now we're in a market where you'll want to be going after the cash flow. Cash flow is going to be your ability to be resilient no matter what the market is. And typically that means giving the renter exactly what they're asking for. So if they're looking for a 2-2, great, give them a 2-2. This is a 2-2 that has great flooring, luxury plank flooring throughout, great countertops. The newer one are now quartz, but here we're looking at granite. Nice shaker cabinets, large refrigerator. So everything a tenant needs is what we're giving them off the bat. And the key is we're not giving them a whole lot more. A common mistake is giving an investor way more than what they need or over delivering and then expecting for the tenants to want to pay the premium for that. And so in this case, we're giving them exactly what they're looking for. We're chasing the cash flow and we're maximizing the performance of this property. Guys, now we're going to dive specifically into the numbers and I'm going to go item by item and go through this together. This is a similar type of style of deep dive that we will do for our investors on our second call. Typically on our first call with an investor, we're going to get to know them, understand what their goals are, understand what challenges they're facing, get to know their unique scenarios, where they're going to walk them through our build to rent process and start explaining some of the various options that we have. Once an investor comes back to us with saying, hey, I'm interested in these 1 or 2 properties, is when we prep for the deep dive. So I'm kind of giving you a speed run of what that deep dive would look like for this property. So one of the keys is the way that we structured is I negotiate heavy upfront for our investors. And the key is I don't want to present anything to our investors that's not going to be an exciting deal for them. That's just not what we're going to do. I would rather present 30 good options than 200 options and have 30 good ones mixed in. So when we look at here, we're looking at obviously a highly functional, and then it's going to be, the price is $420, which is just a little bit above $200 a door, which is obviously a good value. And the bulk of our investors are going to put 25% down. There's options to do less. If you're going to live in the property and do a house hack, you can do as low as 5%. But most investors do 25%. And we have DSCR loans and a bunch of other options there. But they're putting 25% down. And the key is we're able to get our investors a 3.75% interest rate. And I'm going to walk you through how we get there. So essentially, when I negotiate for our investors, and again, this happens ahead of time. So we've negotiated and now we're presenting what we have available to our build-to-rent investors. When we negotiate, I am negotiating, spend all my time staring at these performers, putting the numbers together, making sure that we're able to maximize the benefits to our investors. Right now, our investors are looking for cash flow. They want that guaranteed cash flow. That's what they're chasing for. And so when we negotiate, we're saying, okay, so right now what's killing deals in today's market is the interest rate. That's what's making it very impossible. And if we were to go out and ask for a 2% towards closing cost contribution, it would help, but it wouldn't make an average deal a great deal. And the reason for that is that 2% is the max that you can get on a conventional loan. And so that's, obviously the restraints that we have there. So what we do is we do a forward commitment. And so essentially we're getting the buy downs paid for by the builder. They do a bulk purchase with the lender, and the lender can then go ahead and give our investors unique loans that are qualified only for these properties. And so they're essentially being bought down to a certain point, and then you're able to buy them down further if you choose to. So the most common loan product that most of our investors are going to be going with is a 10-6 3.75% interest rate. When we do a 10-6 ARM, that means that the mortgage is fixed for 10 years, and then it goes to a variable rate interest rate. Now, this interest rate is going to be a little bit lower than if you did a 30-year fix, so most investors go for the lower rate. The good thing about 10 years is most investors are not going to hold on to a property mortgage for more than 10 years. Typically, we would recommend doing a cash out refi in 5 years and maybe a 1031 into something bigger at year 10. But most investors are not going to hold on. But even if you were to hold on, obviously you can refinance then, or you can also decide to just go with the variable interest rate, which will likely be lower than today's rates anyway. Then the other part of that, after the down payment, you have the option to buy down further. So if you were to buy down, it would be about 3.9 points. Each point is a percentage of the mortgage amount, and each point basically reduces the interest rate by about a quarter percentage. You have the option of buying down the points, and here we include it. And again, this is typically what we're seeing to get the best cash on cash returns. And this is what the majority of our investors are doing. If you have a unique question or unique scenario, we have no problem changing the pro forma around for your own unique situation, but this is what the majority of our investors are doing. Then we do the total closing cost. It's just a rule of thumb, about 2.5% is the average closing cost, and that includes your loan origination, your property stamp tax and county taxes, things like that. Things that you're going to buy, that you're going to have to pay for no matter which property you were to go forward with. And then we have the lease up agreement. So technically, the lease up agreement is not part of your closing costs. It's not. So technically, this would come out of your first month rent. And this is a property management's fee for basically getting you up in their system, and then obviously marketing the property, going through the background checks and etc., and eventually placing the tenant. So a lot of property management companies charge a full month rent to place a tenant. In this case, they only charge up a 75%. So again, technically, this is not going to be due at closing, but it's an expense you're going to have, so we go ahead and just include it there. So for about $130, again, with the initial lease up not being included and the $12,000 towards lender points being optional, depending on what you want to do, your total is going to be about $130. And so here's the thing: when we look at the gross rent, and this is something that's very important. These are not numbers that I'm going to Zillow or in the MLS and I'm figuring out, hey, this is what we're asking for. No, these are the numbers that we're actually receiving in the marketplace. So this comes from our property management team. So when I run the numbers on our pro forma, I'm even looking at whether or not we want to add a property to our inventory. We're looking at the actual rents currently being received by the property management company. And so when we go under contract, we're going to get the purchase agreement and the property management agreement. We're going to get both at the very same time. And the property management agreement is going to have the same exact range that we shared with our investors. And again, we're looking at a deal that's available to our investors. But when I analyze all of the possibilities that I could invest in, this is what I decide to go on. And so the key here is we're looking at rents that are about $1,400. And so when I look at my own portfolio mix, a lot of what I own is long-term rentals, single-family homes in high appreciating market. Right now, we're in a stage where the appreciation's not obvious, right? We might be flat this year. We might go up 1%. There's some people that are optimistic that we might go up to 4% the back half of the, but we don't know. Right now, we're not in a very obvious appreciating market. And so what we do know is that I know that there's a lot of benefits of real estate. I have to keep deploying capital, and I don't want to be chasing appreciation when the appreciation is not going to be there. I also already have assets that are in high appreciating market. That's not what my portfolio needs. And when you're putting your portfolio together, you're almost putting up like a team of Avengers. And you're saying, hey, how do these properties complement one another? And so I have a lot of appreciating assets, and I'm balancing those out with a high performing cash flow where, regardless of what happens in the economy, I feel very confident that the duplex is going to do very well, especially at 1,400 per side. Super affordable for a lot of people. So we include vacancy losses, and typically we get an approved applicant within the first 2 weeks of ownership. We also have properties that already have tenants placed in it, or that's completed and is already being marketed as listed. If the average purchase takes about 45 days, oftentimes we have tenants placed in the property before we even get to closing. So we work as a very fluid system with the builder, with the property management team, and ourselves, kind of putting everything together. And we're pretty streamlined. We start advertising the home as quickly as we can. We already know the market rates. We're a well-oiled machine. And so we kind of get this ball rolling pretty quickly. I'm always proud to say that the same people that we recommend to our investors are the same people I'm using myself. So as an example, I'm a licensed broker. I could create my own property management company, but if I sucked, I would still have to recommend me, right? If I owned a property management company, I would have to recommend us whether we were good or not. Because I don't have a property management company, we are specifically moving our investors in the direction of the property management groups that are really good at what they do. And we fired property management teams in the past. It's been about 3 years since we fired one, so we've been on a really good run. But we have fired and let go of property management companies before. And the key there is that we can hold their feet to the fire because they are receiving so much business from us. And so a part of that is we're getting, if you can look at the top, we're getting the rate buy downs paid for in part by the builder, which is a big thing. We're also getting 2 years free property management. And so this is always important to state. Well, the way that we get 2 years free property management is we do a lot of volume. We have a lot of investors, and we sell a lot of the same type of properties. So the outsides may look a little bit different, but the insides are all exactly the same. And for a property management company, they're looking at this book of business as something that they want to have. They want to have this book of business of a lot of new constructions, all in the same general area, and they all basically have the same interior paint, same floor, same warranty company. So it's a lot easier to be more systematic. And so the way that they look at it is that they provide 2 years free property management. You're not obligated to stay with them afterwards. So what they're banking on is that they're going to do a good enough job over the first 2 years that you will stay with them there afterwards. So it'll go 2 years free and then 8%. If you look at 5-year history, that averages out to about 5%. But what they also get is they get a reliable tenant, because tenants tend to stay in the property a little bit longer. They also can get a higher rental rate because tenants prefer new construction. They also tend to stay longer because we're focusing on more secondary markets and there aren't a lot of issues with the homes with repairs and maintenance and everything like that. They're also not having to do a lot of work orders to make these repairs or maintenance. So for them, it's a lot easier, higher income. So they're able to chase our business, right? And we're able to negotiate where it's mutually beneficial. So we're getting 2 years free property management, which is obviously a big get. So when we look at the property taxes and the insurance, so I am very proud to say that my both numbers are super conservative, and I can demonstrate that. So I'm going to talk about the property taxes first, and then I'll dive into showing you guys my actual insurance quote for the same model in the same city. So going after the property taxes. So your actual property taxes are going to be a lot lower than this number for two primary reasons. The first is that your home is either being constructed or it is recently constructed. But either way, it's being taxed at the raw land value. So there's the land and there's the improved property value. Right now it's being taxed at the raw land, which might be, $35,000. So you're paying property taxes for $35,000. And around April is when the property gets assessed by the county, but it doesn't get implemented until the following August. So if you bought a property today, right now we're in June. So you bought a property today, your property is not going to be assessed until April. And then it won't be implemented until August. So the actual effective property taxes you pay are going to be so much lower the number I have here. The second reason why my numbers are very conservative is because I'm going by the purchase price. So I'm saying, hey, let's go by the purchase price. I don't know what the county will assess the property at. On average, the county assessed the property about 30% lower than the actual purchase price. So, and again, this is not an appraised value. This is just a county assessment. And what they do is they want to average it out to what the other people are paying property taxes for in the area. So when you look at their number is going to likely be 30% below the purchase price. And the fact that currently the property is being taxed at unimproved value, your number is going to be way different than this. But for the sake of a pro forma, we know the numbers will catch up, right? So when August does come around, the number will go up to the improved property value. It would be unethical for me to share a number lower than that because I don't know exactly where it's going to land. So I'm going to go with the highest number that it could be. So when we go over to the insurance, this is my actual property that we are about to close on in a week. And the premium, as you can see there in the bottom, that's the annual amount. So in the pro forma, we use a Florida rate average to average out kind of where most homes are going to land. But the area of Inverness, Ocala, this Central Florida region has some of the lowest insurance rates in the state of Florida. It's a little bit more central, it's far away from the coast. And a lot of times the wind and hurricanes get a lot smaller. So if it hits shore at a hurricane 5, by the time it gets to Central Florida, it's probably going to be a level 2 or something a lot smaller. So it dissipates so much. So the insurance are also a lot cheaper as a result from there. And so just the area alone has lower insurance rate. The other thing is when you do a new construction property, the new construction property is also going to be a lot cheaper there as a result as well, because it has the latest truss, right? The staples and straps and all that stuff is going to be the latest. So you're automatically going to qualify for a wind mitigation discount. You're also going to have the latest codes. And so with the latest codes, some of the changes that have occurred is what's called the blower test, where the county is looking to rush air into the house because that's where a lot of the blowout on the windows occur. So that's a test that they have for newer properties. The other thing is a lot of these homes are built on a higher mount. Older homes 15, 20 years ago, they're almost built flat with the land. Newer homes are now built where they're about 6 to 8 feet above the street level. So even if there's a heavy downpour, there's a lot of rain, it's not going to get to the house level because the house is, again, about 5 to 8 feet above the street level. So that helps quite a bit. As we go through the numbers, so again, the number I have here is over 1,000. This is being conservative. Your tenants are also going to be required to get renter's insurance. You're also not going to cover you don't have any personal belongings in the property. And we typically recommend to go with the highest deductible possible. So maintenance is free. There's no HOAs here. And then we have the management is free. The maintenance is at that 2%. So here's the thing. For the first 5 years, theoretically, you should have no repairs needed. If it's the tenant's fault, you'll deduct it from their security deposit. If it's the builder's fault, you have a 210 warranty that you would look to use for that. Theoretically, it would be none. In actuality, you have something. So what happens is in the first 5 years, you can be at 2%. At year 5, you can move it up to 5%. And then at year 10, you move it up to 10%. So right now we're running the numbers as the first 5 years, which again, you should not have that many repairs. Then we get down to the actual net performance. And this is kind of one of the most important things to understand. I have to buy a property regardless of what the headline news are. And it's because of this section right here. So you get all the operating income, you look at the debt payments, you end up with a cash flow. Cash flow is very healthy. This is a very healthy cash flow. And so cash flow is almost like the heartbeat of your deal. If there's no heartbeat, don't buy it, right? If there's no blood circulating, your deal is dead, you should not buy it. That just does not make sense. Don't buy a dead deal. But realistically, you're not going to live off the cash flow. You may reinvest it at some point, but for the most part, cash flow is there to keep the deal alive. And you don't want to fund the deal. The deal should be self-sustaining. It's also there in case a tenant moves or whatever, you have enough reserves there to take care of that. That's what your cash flow is there for. You have the principal reduction. I always jokingly say every property buys 75% off. And so your tenants are paying down your debt for you. It's a massive wealth creator. And so we include the principal pay down here. Then you have appreciation. And this is just over the course of time, the house will go up in value. We did a previous video where we shared the reasons why costs keep going up. A lot of it has to do with labor. A lot of it has to do with material. A lot of it has to do with the cost of financing. A lot of it has to do with inflation. A lot of that has to do with population growth. These are all factors that are not changing. They're always going to go up and to the right. And so will the cost to replace this property, which means that this value will go up over time. And so then we also look at the tax savings, and it's a fourth one that's often is missed. The tax saving is massive. So here we're showing the stats on a standard depreciation, but that's basically you're deducting the improved property value over the course of 27 and a half years. Same. So you can also do techniques like bonus depreciations where you move forward the depreciation to the first 5 years. And you can also do what's called a cost segregation report. And we actually help our investors do this for them. The point is, when you look at all the net benefits of owning the property, you end up with about $56,000. $56,000 is about 40% of the initial investment that you made in the property. You're getting back right away. And so we're getting a very healthy 6.2 cap and a 6.7 cash on cash. And the key is we always run the scenarios where we look at, okay, what about 5 years? How do we scale? How do we grow? We typically push doing what's called a slow burr, not a rapid burr. A lot of rapid burrs is how you get caught and you lose everything. We're doing slow. We're letting time work on our behalf. But you can start pulling money out fairly soon. Typically, we wait for about 5 years, and then you do a cash out refi. The cool thing about a cash out refi is it's not a taxable event. You don't pay taxes on borrowed money. And also, you're still leaving equity in the deal. So you're not taking 100% out. So you're able to take out about 180. That's now enough to buy another duplex. And I always say that the goal of any investment is to become a grandparent. That's where your investments can make more investments, but you didn't have to put more capital in the deal. So we have a number of scenarios here that we can play with. And then we can also look at if you were to sell it after 5 years, you would net over 207 under these calculations, which is obviously massive. And your total IRR, which is your net benefit after everything, would be 300. And I always think that the IRR is the best number to use for a sophisticated investor. So we're scroll back up. And so here we're looking at a 5-year IRR at over 30%. So a lot of people ask like, hey, why would I buy a property when I can get these returns in the stock market? And it's like, dude, you got to look at all the wealth creators of real estate. And in this case, you're not going to get 30% in the stock market, right? Especially with like, we have 4 ways of building wealth. You only have one, and that's to sell it. And you got to sell that at the perfect timing. With real estate, I can sell a property each and every month. That's going to be it for today. Thank you all for sticking around. This is the same property that I bought. I'm super excited to share these numbers with you. I'm expecting the same numbers that I showed here. And so this is going to be a huge success all the way around. And I love sharing. So if you have any questions, you have any comments, if you want to schedule a consultation, please leave a link below. And I look forward to meeting with you then.